2025 was the year with big promises: AI, efficiencies, automation. But inside global organizations, something else became clear. 2025 wasn't the year where everything became easier, but it was the year where everything became visible. Let's go through 6 shifts purchase-to-pay leaders had to navigate in 2025. AI was everywhere. Companies implemented invoice bots, matching tools, and approval assistants, hoping for a smoother process. But instead, AI exposed long-standing issues like mismatched vendor data, late or incomplete POs, approval flows that weren't documented correctly, and processes that were different region by region. And many organizations realized that AI only works when the core process is stable. And for most of them, it wasn't there yet. So, AI didn't replace the work. It revealed the work that still needed fixing. Shared services finally moved from the back office to the decision table. And leaders started asking bigger questions. How well are we controlling our spend? Are we reducing risk? How well do we know our suppliers? And so, shared service centers became part of bigger conversations about cash flow, compliance, and supplier stability, and no longer just about transactions. Payment fraud became smarter. Finance teams started receiving requests that felt uncomfortably precise, like bank details changes tied up to the real invoice number, emails written in the exact tone of the supplier. They felt personal and believable. And so it became clear that the vulnerable spot wasn't in their systems, but in the process around the supplier onboarding, bank changes, updates, and informal approvals. Trust and verify stopped being an advice. It became the rule. Cash got tight this year. Companies started looking much closer at when money left the business, and AP role changed. Leaders started asking themselves, are we paying our suppliers earlier than necessary? Which suppliers keep our operations stable? Do our terms support our cash position? And that's how AP found itself working far more closely with Treasury and FP&A, because payment timing directly shaped liquidity. Vendor reconciliation still remains one of the most time-consuming and hardest parts to automate in P2P. Even with better tools, many companies still cannot get a reliable view of their payments. And not because their ERP systems are wrong, but because a lot of information sits outside it. The environment is simply too complex for most tools to deal with. We have different statement formats, we have different languages, regional differences. And in a year where payment timing mattered more than ever, the lack of clarity held teams back. For years, every organization talked about end-to-end process, and many even implemented global process owner role to support it. The reality in 2025 is the setup didn't really function the way people hoped for. GPOs often lack the authority to drive end-to-end change because of silos, legacy systems, slow change management, and local teams driving decisions independently. 2025 made one thing clear: end-to-end can truly work when someone can own the full process and not just a part of it. In the article below, we're breaking down all the shifts that we collected and we noticed that helped AP leaders navigate to 2025. It wasn't an easy year, but I'd love to hear from you. What worked in your company? What stood out for you? And what else you'd like to add? Have a look.